Hej, välkommen till Börslunch på efn.se. Ja, idag är vi alltså på Nasdaq, Times Square, och det är för att ta tempen på den amerikanska marknaden.
Precis, och med oss idag har vi Ed Lugo som är förvaltare på Franklin Templeton. Welcome to the show, Ed.
Yeah, thank you. I'm happy to be here.
Good to have you here. Could you start off telling us a bit about yourself and your role at Franklin Templeton, please?
Sure. Yeah, I have about 20 years of experience. One of the things that I do at Franklin Templeton is I run a global small mid-cap fund. I run a European small mid-cap fund, and we also run an international or non-U.S. fund. That altogether, we have about $5 billion of assets. Now, the firm, Franklin Templeton, has $900 billion.
So it's one of the bigger.
It's one of the bigger firms, on Wall Street.
Great. So you have a lot of knowledge about small and mid caps all over the world.
That's right.
Exactly, just what we need today.
We're going to talk a lot about small and mid-cap firms, but I wanted to ask you to begin with your review of the general market today.
Sure.
Where do we stand? Are we in a bear market already, or where do we stand?
Yeah, it's an interesting question. One of the things that was driving the markets today is certainly commodities. It's what's happening in China, causing a lot of volatility. I think everyone was a bit surprised when China announced that devaluation, which really kind of have markets moving downwards. Mm-hmm. Now, keep in mind, China, it's already been known that China has been slowing down. Mm-hmm. Oil has already fallen. Commodity prices have already declined. So that's already in the market. And we've been looking in those areas for investment. Now, that has been affecting the U.S. market, which in our assumption, we believe it's overvalued, especially small and mid-cap stocks. However, Europe continues to be quite attractive in that space. So overall, a lot of volatility. We expect it to continue. The key point is watching China.
Do you think is it an overreaction as everything was known, as you're saying? Was it an overreaction to trade down?
Yeah, it's a bit of an overreaction in the sense that the surprise, the devaluation of the renminbi, the recent moves by the Chinese government to support the market, it's just showing clear signs that something is happening. It's very hard to know exactly what's happening with Chinese GDP. As we all know, some of those numbers are not real. So as a result, when it comes to China, it was a bit of a surprise. And then you had this overreaction. Mm-hmm. What's going to happen to oil going forward? What's going to happen to commodities are the big questions that are out there. And as a result, all I can say is that most likely we'll see this volatility. In terms of what we do, we take advantage of the volatility. In fact, we have been quite aggressive in buying certain companies in certain industries, given what's happening in the markets today.
So could you actually buy into companies that are sort of out of fashion right now? We can see in Europe, people trying to stay away from, with any company that has China exposure, for instance. But you're trying to go against the trend, or?
Yeah, that's typical for us. We try to find companies that have strong competitive advantages, good balance sheets, trading at a good price. The only way you can find these very good small and mid-cap companies, typically what we believe is you have to get them when something's happening. For instance, I'll give you a quick example. When China starts falling in the way it is today, what do we start doing? We start looking at Chinese companies. We start investing in Chinese companies because it's a time where you can get them at a good value and you can have a good long-term return as a result. And that's typically what we do. We actually feel when these markets go down, the risk is less, provided that it is a good company, a leader in its field. And we can talk about some of those, but it's typically the way we look at it.
So how sure can you be when you enter something which is depressed? That you're, where do you want to hit the bottom? On the way down or on the way up? And where do you?
Usually when we're buying a company and it's falling quite a bit, the way we get conviction is really looking at the balance sheet, looking at the business model. And yes, the company can be down 20% in value. We could be purchasing it when it's down 25%, buying some more when it's down 30%, buying more than when it's down 40%. The reason why we do that is because the business is becoming cheaper, but the conviction really comes from the business model and the balance sheet. And I can give some examples, but that's typically what we look for. It's that protection on the balance sheet that we really need. The company will survive. We need to make sure that company has a good business model where the business is going to continue to thrive despite the recession. And also that protection on the valuation. As it goes down, it becomes much more rewarding in terms of potential returns in the future.
So where do you find that today?
Well, we find it in different areas. Right now, the key areas for us is shipping, for instance. Specifically, dry bulk shipping. It has been very weak. Dry bulk shipping is the transportation of iron ore, coal, and grains. That specifically is in reaction to what's happening in China. We've had daily rates for, let's say, a Cape-sized vessel, which is one of the larger vessels, roughly about 180,000 deadweight tons. Those types of vessels have been running, used to run, just to give you a sense of scale, they used to run $150,000 a day during the peak for 1 day of rental for these boats. Today, they're closer to 9,000 or less. So these rates have fallen quite a bit. We're experiencing multi-decade lows. The results of these ship values have come down quite a bit, and that area is quite attractive for us. Also, in addition, is oil. We've been looking at oil companies. In fact, we just purchased our first oil company into our portfolios for the first time in 5 years. We got out of oil back in 08 and 09. We typically are very careful investing in oil-related companies because it's a commodity market, and it's very difficult for us to invest in a commodity market where the cash flows are unknown because it's depending on the price of the commodity. For us, it took all this time to get to about $30 to $40 per barrel where it becomes attractive for us again.
And is it also dependent on how much the oil price rises to, or can you still get a good investment if the oil price stays at 30, 40?
Well, that's the key. That's exactly the key. The oil price can stay at $30 to $40 a barrel, and we still can get our minimum 10% internal rate of return that we want on our investments on an annual basis.
So which company is this, and what does it do in the oil business?
Well, I mean, a company that we have today that we purchased for the portfolios, and it's public knowledge, is called Amec Foster Wheeler. Amec Foster Wheeler is a consultancy engineering firm. They design the oil platform for you, or they consult on your oil platform in the North Sea. They do everything from refining. They look at the upstream market, which is exploration and production. They also in other areas. Now, keep in mind, oil and gas is about 48% of their business. But the key is that they maintain a strong balance sheet. They have a business model where they can adjust, because remember, this is people. They don't own the assets. All they do is consulting and engineering. And finally, it's trading at a very attractive price, where today you can get a 10% return on your investment annually based on the cash flows that it's generating based on today's price. And that's exactly what we're looking for. So those types of things. Now, we're looking for more of that in the oil business. We haven't found much yet, but we continue to look even at this time.
So we're going to talk some more about your specific cases. But right now, everyone's sitting on the edge of the seat. We have the Q3 coming up. Alcoa started out last week.
That's right, yeah.
As expected, they were sort of pessimistic about China, fairly optimistic about Europe and US. The share was down.
Yeah.
What is your overall picture of the report season we're coming into? The expectations have come down.
Yes.
Has it come down enough, do you think, or are we going to be?
It's difficult. It's difficult to say. Of course, it depends on the industry.
Yeah.
You mentioned Alcoa, which is obviously aluminum related,
Yes.
or metals related. We're seeing the same with oil companies. They tend to be a little more pessimistic. We see companies where they're looking at the China exposure, just like you said.
Yeah.
I mean, I can reference one company we own in the portfolio today, which is Valmet, which is a paper manufacturer. They make the machines that make the paper. They make machines that make the pulp. And Valmet is a world leader in this. They have China exposure. They're looking at that. China's about, I want to say, 10 to 15% of their sales. And they're looking at that. Because keep in mind, in the case of Valmet, their China sales, the manufacturing of paper, is dependent upon the import of pulp.
Yeah.
And pulp is produced in South America. So you also have to look at the South American sales of Valmet to get a better picture of the overall impact to companies like that. So that's why I'm saying it's a bit complicated.
Yeah, it is.
But for the most part, we expect it to be quite weak.
But I was still sort of surprised that the Alcoa share was down so much, because it couldn't have come as a big surprise that they were like pessimistic when it comes to China. I thought that could maybe be like in the picture, in the cards. Yeah.
Yeah, you see some of that. It's in the cards, but once you see it in the numbers, that's where we get the reactions. And we've seen that a number of times. And the same with a number of our companies as well.
Okay.
So.
You're a lot in the small cap sector.
Sure, yeah.
In Sweden, we've seen that small caps have fared much, much better than large caps.
Yeah.
But we don't see, and we have a graph of this actually, Russell 2000 versus S&P 500, and there's not that much of a difference.
Okay.
Why would you say that is, and why would you see the big differences you see in the Nordics?
Yeah, I would even scale that back, even looking at, if we look at the Nordics and even went into Europe, you see small caps doing better.
Yeah.
And part of the reason is, keep in mind, Europe has been quite weak overall on the global scale since 2010, 2011. In fact, if you look at our portfolios, especially our global portfolio, we're very, very overweight Europe. Because of the Eurozone crisis, we found opportunities across Europe, of course, some in the Nordics as well. In the US, it's a contrast. US has been booming since 2010, 2011. It's been doing quite well. Small caps have done very, very well in the US. And today you don't see that kind of what you find in Europe today. So we still think that, small caps have caught up. The US market has caught up. We believe, again, it's overvalued. So right now the opportunity, we still believe, is in Europe with respect to these small and mid-cap stocks.
But even though they've fared so much better than...
They have, they have fared better, but Europe still has a ways to go to improve. I mean, QE just started in January of 2015. We see some of those effects beginning to take hold. It's kind of a multi-stage process. The first reaction you typically get on a QE is market jumps up. Second reaction is you begin to slowly see positive sentiment in the economy. And finally, you start seeing the numbers really come into the earnings estimates, and that's when you really see the markets rise. But we're not even in stage 2 and 3. We're still in the, well, I would say we're getting into stage 2 where you see some of that. Then we had Greece that came in, and of course that put things down for a little bit, but Europe is still the place.
But you're trying to be ahead of the rest of us. So have you invested already then?
No, we have already invested in Europe. We have been in Europe since, again, 2010, 2011. We kept adding. The last big move we went is going into real estate, specifically in Ireland. That game is over now. Now we're looking at Spain. Spain is still very attractive in terms of investing in real estate. They have real estate investment trusts that are available for public shareholders that are still quite attractive. But we continue to find areas there. But now we're moving over to shipping, mining, and also into oil. And those are the areas to look for the future, like you're saying.
But one of the reasons that small caps are doing so well in Europe is that they have a big domestic exposure. They're not sort of exposed to the global uncertainty, less FX exposure. And I thought you would see the same in the US. We have a graph that shows that hedge funds managers in the US in the past months sort of have, it's peaked when they preferred the small caps. And I thought you see the same reasons here as in the Nordic or Europe. Bigger domestic exposure, less global uncertainty.
Yeah, you see some of that in the small caps. That helps.
Yeah.
But a lot of these small cap companies, one will be surprised, even if we go across our portfolios, for example, we see roughly half are very domestic focused in the small cap space, and half actually have good operations that are international. It's not uncommon to see that. So you see some of that. Yeah. And so what we see is, yes, it could be European small caps could have done well because they don't have the exposure to Asia. However, there are a number of companies where they do have exposures and they have been underperforming recently. Keep in mind, yes, you could have domestic exposure. I'll give you a quick example. If you were looking at a domestic, say a domestic oil company in Europe, obviously it's going to be affected by what's happening in Europe. So that we find some of that, and that's why actually we're finding opportunities in Europe. So I mentioned Amec Foster Wheeler earlier. That's a UK-based firm, but they have operations, certainly around the world. And so we're finding companies that in these areas are still being affected. And of course, there's a market, when you say small caps as well, keep in mind that we do have situations when markets get volatile, small caps tend to get hit quite hard in the beginning. And we've seen that some of them get hit, but they come back typically when things improve or information is better. So.
You've owned stocks in Sweden.
Yes.
You don't own any stocks now.
Yes.
Is there any reasoning for, is it Is it expensive in Sweden now? Is that why, or is
Hard
it just a coincidence?
Yeah, it's both. It's kind of both. For us, we find good cases in Sweden. We like certain companies in Sweden. It's a great place to invest. We've done it in the past. We found great companies there. The issue for us is just valuation, simply. And so for us, when we found opportunities, the key point for us is good companies, but they have to be inexpensive. So again, usually an overlooked scenario or a place where no one wants to be in. So.
And many people want to be in Sweden now. So.
That's right.
But you have other Nordic investments. You mentioned Valmet, but you also have...
Yes, we own ISS. That's one of the largest providers of facilities management, cleaning services. 49% of the business is cleaning. They have property management. That's about 20% of their business. So that's taking care of the lights and making sure the property is being taken care of. And they have some other business, for example, catering and security services. So ISS, what made it very interesting is that it IPO'd in the beginning of 2014. The business has been around since the early 1900s. It's been around. In fact, it used to be listed in Denmark. Yeah. It actually got first listed in Denmark in 1977. So key point, the things we look for. Does it have a competitive advantage? The answer is yes. They have operations around the world. They're primarily focused on Europe. About 73% of the business in Europe. Most of that is Europe, Western Europe, and they also have the Nordics. It's a big area for them. The second thing is that they were heavily indebted at one point. They were listed on the Danish market. They got taken private. They were owned by a private equity firm for a while, and they spun out recently. But during that whole time, they built up the business. They made acquisitions. It was heavily indebted. They started taking down the debt. When it went IPO on the market, it had about 4 times net debt to cash flow, or what we like to use, earnings before interest, taxes, depreciation, amortization. So it had a high debt ratio. But that has been coming down. The IPO, they used that cash to pay down the debt. In addition, it's a very, very steady business. Imagine cleaning services, imagine property management. The business generally has about a 5 to 6%, actually more like 4 to 5% margin. It tends to grow 2-3% a year. And even during the crisis in 08 and 09, the business continued to grow. So it's a very steady business. And it was just pretty much undervalued when it was IPO'd. In fact, if you ran the calculations back then, I mentioned how we like to get that 10% return on our investment. So if IPO came out at 160 Danish kroner per share, it was generating about an 8% free cash flow yield, 7 to 8%. We're getting 2 to 3% growth on the business. So you add it all up together, you get about a 10% return on a very stable business. And that's why we liked it.
Is it easier nowadays or harder to find good deals like that? If you compare to a year ago or 5 years ago, how has it developed?
It is harder in terms of valuation. It is harder in places like Sweden. And however, what we find is that there are always areas or pockets of opportunity. If I just named you a few things, if I mentioned China, if I mentioned Brazil, if I mentioned Argentina, if I mentioned the oil industry, again, mining and shipping, those areas are the areas of opportunity today. Even though they're not attractive on a superficial basis, but from a valuation perspective, for the first time in years, we can get good companies trading at very attractive prices. And that's essentially what we're looking for. So opportunities are still there. It's just what you'll end up finding, in fact, is our portfolio shifting into these areas over time.
So you're contrarian almost. It sounds like when you talk about Brazil and oil companies and so forth. So I think we're starting to get a good picture of how you sort of do your bottom-up investment strategy. What would be the best, when you start looking at a company, what are the main things you look for? You got the competitive advantage and so forth. What would you say?
Yeah, competitive advantage. The main things we'll look for is that competitive advantage, really understanding the business model throughout the cycle. The hope is that we have a good management team that actually has a good track record. That's also very important. Good track record. So we got the competitive advantage. So typically our companies tend to be leaders in their field, ISS being one of the world leaders in cleaning services, Valmet being number 1 or number 2 in paper machine manufacturing and pulp machine manufacturing. So those are the types of things we look for: strong balance sheet, and finally, attractive valuation. And that is the hardest. It's just because we really are pretty resilient in saying we want that minimum 10% annualized return on our investment. If we buy it at 100 Swedish krona today, we want it to be 160 over the course of 5 years as a minimum. I mean, of course, if we can get, but that's in a worst case environment.
Yep.
So that's what we're looking for. So in order to achieve that, we end up being this contrarian-ish type of investor because valuation is driving the allocation of the portfolio. Okay. So we're always being forced to get a 10%. Yeah, sure, we can buy a great company in, today in Europe or even in Sweden, and we can get a 3 or 4% free cash flow yield. But you can tell immediately that's not a good enough return for the risks that we're taking and the investments that we're making.
Okay. So what's the average time you hold the position?
Yeah, the average time, our turnover today is roughly about 15 to 20%. Yeah. So we hold stocks 5, 6, 7 years in many cases. Okay. And that's very common for us. So very long term, bottom up. We also run a concentrated portfolio. Mm-hmm. So we don't have many names. For example, our global portfolio has 35 companies. Okay. Wow. So just to give you a sense, it's picking high conviction companies, and so it's really a stock picking approach.
So which country do you have the biggest exposure to right
well,
now?
In fact, right now, one of the biggest exposures is Ireland.
Ireland, okay.
Yes, in fact, just to give you a sense, back at the end of June, we were 17% in Ireland versus the benchmark that we go by, the global benchmark, which is 1 or 2, actually less than that, around 1% in Ireland. So you can see that we don't follow the benchmark. Okay. And the reason why we went to Ireland was because of what happened in 2008, 2009, 2010, getting involved in real estate. We own the largest hotel operator, Dalata Hotel Group. We own Green Real Estate Investment Trust, which focuses on commercial property. We own companies like Irish Residential Real Estate Investment Trust, just to give you a sense. Okay. So really focusing in Ireland.
You make it sound so simple.
Yes.
Just go for the balance sheet, go for...
Right.
Yeah. It's a nice long term. And since you have your positions for such a long time, you don't have to sort of get cold feet when market gets too volatile.
And that's the key. That's the key. The key is not to get cold feet. The key is to follow that process. Mm-hmm. You're right. On the surface, it is simple, without a doubt, just by talking about what we're saying. But what makes it hard is having the temperament and the emotional wherewithal to just stay there, to buy oil companies when oil is collapsing, to get to, and you don't know how far it's going to go down. So you have to use these metrics of balance sheet and valuation to really support your thinking. And the emotional element is very important.
Keeping calm.
Yes, keeping calm is very important.
Thank you very much for coming here, being our guest today.
I appreciate it. Yeah, thank you. Thank you for your time. Thank you.
Och tack alla ni som har tittat. Imorgon är vi tillbaka här från Nasdaq i New York. Vi har alltså Kevin O'Dowd med oss från Stifel Nicholas och Christopher Bourdain från Handelsbanken. Se oss gärna imorgon klockan 6 igen. Tack, hej.